Good day, everyone. Welcome to my 10th Wealth Talk Show episode, where my goal is to provide you the tips and tools needed to enhance your personal development, financial literacy, and also start building for your retirement. And of course, giving you all the knowledge that you need for real estate. And I could not be more excited for today's episode. I'm really pumped to see who's in the house today. We got my main man, Dean Inniss from Rocky Mountain Mortgage, one of my awesome preferred lenders. He is the president of Rocky Mountain, and he brought his amazing sidekick, his vice president, Brenda Aguirre. Guys, thank you so much for coming on to the show. Tell us a little bit about yourself, Dean and Brenda, and then we'll get started on today's topic.
Well, thanks for having us, Rick. It's really great to be here. A little bit about myself. I have a bachelor's of science in economics. I've been in the business about 34 years. I've been with national lenders, regional lenders, and now local lender. I think it's exciting what you're trying to do to help people with their literacy, and we're excited to be here to help you with that.
Love it. Brenda, what you got?
Well, I can tell you, I don't have 33 years. I have 10 years, unlike Dean. Yeah. But I came from a credit union, so it's really nice to have go from one local credit union to a local company, which is a lender, which is Rocky Mountain. Mm-hmm. So it's very neat and exciting. So yes, thank you very much.
And just because we say local doesn't mean it's small either, though. You guys are massive in nature. You guys could pretty much service all of Texas or anywhere for that matter, really.
You know, we can do loans all over Texas and New Mexico, and we have. So we service loans here locally, and we have a portfolio of over $1 billion.
Awesome. I love it. I love it. Well, let's get right into it, guys. You guys know that my Wealth Talk show is really just to provide easy to swallow content for all of our listeners, whether it be for developing their financial literacy, starting their retirement, reducing their debt, and of course, being a real estate broker. I want to make sure that I inform my buyers and sellers as best as possible to try to give them the tools that they need so that they could become informed. So let's kind of get into it and unravel that. The do's and don'ts. What are some of the do's and don'ts, guys, for a buyer who's thinking about buying a home in 2019? Let's start with some don'ts. What are some don'ts that we should not absolutely be doing if you're today's buyer?
Don't change your job.
Love it. Don't change your job. Why not?
Well, you do need the experience. We're looking for a 2-year history. Depending on whether you're self-employed or not, it makes a big difference. So you want to make sure that you're stable in your income. You know, if you're changing jobs for an increase, then okay, great. And if you're in the same line of it, but if you're not, it does pose a threat. I mean, it causes challenges for the lender.
Awesome. So give me an example when you say allowable to change your job, but staying within the same type of industry. What would that look like for our audience?
Let's just say a nurse, for example. You're working for one hospital and you go to another one. Okay. So, you know, sometimes there's a lot of opportunities. So that's something that you want to kind of keep. So if you're still doing the same line of work, then that's okay. You're still going to need 30 days of a pay stub, you know, of your new employment, but you just want to be consistent in what you're doing.
Horizontal movement is okay, is what we're looking at.
Correct.
Yes. If I am a truck driver and I become a teacher, different story?
Yes.
Different story, right?
That can be doable.
Doable just because the teacher has a sustainable contract, I'm assuming, right?
Correct.
All right, what's another don't that we're looking at?
Don't go looking at a house before you're pre-qualified.
Love it, and that's going to be one of our topics later on in the show, but why is that important?
Well, you know, you don't want to get disillusioned. You might fall in love with the home and you don't know if it's affordable, if you qualify. I mean, a lot has to go in stake versus maybe you're renting versus buying a home. You know, all of a sudden now you're going to have a monthly payment with 5 different utility bills that you're not used to having as an apartment, you know, as a renter.
Perfect. So don't go get pre-qualified, or don't go looking for a home before you get pre-qualified. What's another don't? What do you think?
You know, I would say that a little background on this. In 2010, there was a Dodd-Frank bill which changed the way that lenders have to look at lending. And I think that a lot of our community and public at large doesn't realize what that entailed. And one of the things that it really entailed was the lender now has a responsibility to show that you have 3 years of future potential ability to pay on your home. Mm-hmm. So that brings in the stability that Brenda was talking about as far as your employment 2 years before, because at least it gives us, even though we don't have a crystal ball, it gives us the indication that you're employable. The other thing is credit is hugely important because, again, we don't have a crystal ball. So as a lender, you have to identify what trends give you the ability as a lender to say this person will pay that mortgage. One of those is rent history. The other is your personal credit. So a big don't would be do not be late on payments. Pay payments on time. always pay them on time. The other thing is don't look for a lot of credit just prior to buying a home. Don't go buy a car. Don't do any major purchases that could upset your financial history. Be consistent in the way you handle your personal finances. Don't have large expenses that would normally not happen in your routines. Make sure that you control those things.
These things seem super obvious to us, right?
Yes.
But
not to the buyer.
I'm sure you see crap all across your desk all the time.
We actually see a lot of people furnish the home without having the home. Or they'll buy a car.
Through lines of credit, probably.
They buy a car the day of closing. But unfortunately, there's nowhere to place that car unless you're going to live in your car now instead of the home.
Oh, my gosh. All right. So any last remaining don't that you think absolutely not under no circumstances you should be doing?
Don't be moving your money around. Leave your money where it is.
Okay.
And if you have mattress money, since so many people are notorious for leaving that mattress money, whether it's still because they don't trust the bank, whatever the reason is, it's easier if they go ahead and deposit it and leave it. But the biggest thing is don't move money around unless you're able to trace it, because you're going to end up having to do a lot of explaining. And we're just trying to make the process easier.
Dean, I'm going to piggyback on that great tip that Brenda just gave, is talk about seeding your money or making sure that money is sustainable or stays in a certain account for a certain long time. Is that important for you guys as lenders?
Incredibly important. I would say that if you're looking at a home, make sure you put your money in the bank prior to even start looking for a home. Mm-hmm. Because the ideal, if you buy a resale home, you're looking at a 45-day process for the loan process at the maximum. I mean, it can be 30 days, but 45 days. While you're shopping for the home, maybe another month and a half. So we look for 60 days worth of seasoning. And so my advice is always put your money in the bank long before you even think about buying a home. That way, there's no discussion. It's your money. It's always been your money, and we move forward.
It's easier to trace.
Absolutely.
Absolutely. All right. What about we talked about the don'ts. What about some do's?
Do get pre-qualified and get a realtor to work with. It's very important.
Love that. We get so many people that you ask them, are you pre-qualified? Then they say yes. And some of them are even reluctant in giving you the lender. And for me, I'm like, why are you reluctant? In fact, realtors are a little bit more open once you know that they're pre-qualified. But today's trend, I'll give you some of my pulling of the hair moments for me and my realtors. And not only that, but realtors across the country, where they'll call you and say, I want to see this house. Well, are you pre-qualified? No, I don't think I'll have issues with that. And then 2 minutes later, one of my other agents gets a call because they happen to have a listing close by to the listing that they were calling me on. And then they get a call like they want to see a house. And I'm like, this is the same freaking person. They're just jumping around.
Yep.
There's jumping around. Buyers are just jumping around. Don't do that. Don't waste anyone's time when it comes to that.
Well, I'm sure you've talked about this before, but realtors have to go through classes, school, and they have to get licensed. And one of the things that lenders appreciate are the licensed realtors because of the ethics they have to go through, the fiduciary responsibility they have to their borrower. Mm-hmm. So it is important to be pre-qualified because then they can help you make the best decision for you.
Absolutely. What's another do?
Do save money for a down payment. It makes a difference.
So all those entire calls that we receive, well, do you have any DPAs, down payment assistance programs? I mean, why is it important for you to say for down payment? There
is buyers that really, really need it. But there's, if you sit down with the mortgage advisor, and I'm going to call him an expert, okay, and I'm going to say an advisor because that's what you do is you advise them, giving them the best option. It's something as simple as saving a little bit of money every paycheck or pretending that you already have a mortgage payment. You'll come up with your down quicker, but you'd be surprised. You're not at a higher interest rate. You're going to save money over a 30-year term. What you're thinking you're saving now, you may actually have a second lien. So you're doing a mortgage now instead of 30 years, now 60. Mm-hmm. And at a higher rate. So yes, you didn't come in with money, but it's something simple that all it is it's basically changing your mindset, of saving a little bit of money, and you'd be surprised how much you save. And that's why it's important to go to your mortgage lender so they can do a comparison and show you the difference. Educate the buyer of why maybe down payment is not necessarily, the way to go, but it's actually an easy way to get a down payment and save for it.
And for me, then that helps, going back on what you're talking about, Dean, it helps my company or realtors across the country, really. I love it when a buyer comes to me and says, I'm pre-qualified and I have $20,000 down. I have $35,000 down. That lets me know that we talk about this in our industry a lot, having skin in the game, right? And if most people don't live in their home for 30 years anymore. That's the reality. That's the truth, especially if you're in the military or if you're a type of industry where you're constantly relocating. And so when that major shift occurs, if they got a correct loan that fits their finances and they use the correct broker, then they could move out on the back end and make a little bit of money because they bought correctly, they got the correct loan, correct down payment, and they have equity.
Yes.
They have equity.
Versus being upside down.
Yeah.
You and I talked about this a week ago, and one of the things that is a common misconception in El Paso is that nobody does have a down payment.
Mm-hmm.
And my thought process is that's not true. The rest of the country averages a 19% down on a purchase.
That's insane.
And
19%.
everybody says that,
19%.
right? And they say, oh, well, that's insane. That's because the rest of the country is rich. No. You know what happens is the rest of the country is very competitive on mortgages and sales.
Mm-hmm.
And if you have a down payment, it's much easier for the realtor to get that contract done because you're coming in ready to go. And I think that the misconception is everybody has money. Well, it takes 14 years to 15 years to save 20% down on a mortgage,
that's a lot of money.
no matter where you live in the country. So what's the difference? Well, an interesting article in the Wall Street Journal came out a couple of weeks ago. The number one bank in the country is the bank of mom and dad. And I'm going to tell you, in El Paso, mom and dads are pretty prevalent here too.
Yeah.
The difference is they buy their kids a new car or a quinceañera instead of giving them a down payment for their house.
Yeah.
And to me, and if you guys and the public that we're talking to, talk to your parents about a down payment situation, because what it does for you is gives you equity up front, but it also helps you build equity quicker. Because when you have a smaller principal balance, more of your payment goes straight to that principal immediately.
Love that.
And when you're talking about wealth building is not a 30-year mortgage. Wealth building is not 100% financing. Wealth building is taking an asset, developing equity, and accelerating that equity with additional down payment, additional monthly payment, and all of those things are small differences that people think are huge, and they're not.
Absolutely. I am a big proponent of putting a little bit more money, more skin in the game, because the reality is, like, for example, I lived in LA. I think I moved in LA maybe 2-3 times, and then I lived in New York, and I lived in Manhattan, Brooklyn, Queens. So I moved 3 times when I was in New York City. So imagine you're going to have those major shifts that occur that cause you to move. So you want to be financially ready when that occurs. And a lot of our military buyers here in El Paso, a lot of them sometimes are not. The VA provides an amazing loan structure for them, but if not careful, it's fool's gold, because if they get PCS orders and they get deployed or they get shipped to another base here in the country, then they're left out to dry because the appreciation on their home was not big enough to you're talking about lack of equity in that product.
Let's put this in real dry terms that everybody can understand. I'm Dean. I'm a staff sergeant. I'm getting ready to transfer to Germany. I bought my house 2 years ago. Rick, can you sell my house? Mm-hmm. I had $500 down payment, and I got in my home. And I'm ready to move out, and I haven't paid any extra, but I've been in it 2 years. Can you make that happen for me?
I could sell you the home, but because of closing costs and commissions and title fees, you're going to lose money. And unless you live in a metroplex where the appreciation is just crazy, you're talking about like New York, Miami, LA, Scottsdale.
But that's really like 5 or 10 places in the country. That's not the real norm.
Exactly.
So you just displayed for me what that staff sergeant's going to go through 2 years later if he gets PCS to Germany, and you say, I can sell it for you, but how much money do you have in the bank to cover the difference?
Exactly. So you're going to pay a down payment, whether it be at the beginning or you're going to pay it at the end with what's called a loss.
Just more costly at the end.
Absolutely. And no one likes paying at the end when you're selling your home.
Another important thing, Rick, that I think it's very crucial for buyers to understand is you have to be honest. Be honest with your lender. And the reason I say that is if you're going through a separation.
You're saying buyers are liars?
No, I'm
No,
not. I'm saying there's verifications that come out,
There
and
you
whether
go.
you
There you
say
go.
it or not,
There you
it
go.
always comes out.
Financial truth comes out, yes.
Financial truth always
Mr.
comes
550
out.
credit score was actually a 550. They were in an 820.
Yes,
Yes.
exactly. So the biggest thing is, sometimes we encounter people that say, they're married, but they're separated and don't want something coming out. And reality is, Texas is a community state. So with that, there's a lot of things that unfold. So it's just really important that if you lose your job, you change your job, your marital status changes, you were late on a payment, that you let us know, because it's going to come out, and all that's going to do is pose challenges at the end. So instead of us getting a projected closing date, it's going to actually do obstacles for us.
Absolutely. I tell my buyers when I'm sending them off to get pre-qualified, these people are going to be your counselors. You got to be real with them. You got to let them have it. They'll help uncover and solve your dilemma. So if you're honest with them from the get-go, they will be on the plan to assist you to get you pre-qualified. But if you tell them, oh, but wait, underwriting, this is what's happening. I actually quit my job 2 weeks before closing, or, you get the point. So, all right. Moving on to the next one, guys. You kind of already talked about it. Let's expand on it just a bit. I have this problem. Help me solve this problem. Lenders have this problem, right? Why home shopping before getting pre-qualified is such a big mistake. But before you even answer that, why is this even occurring, though? Do you think it's the advent of social media and all these amazing apps like Zillow, Trulia, and Realtor.com that now buyers have everything at their disposal as far as finding and searching for a home? So why do you think it's occurring, and why is it a bad thing to be doing?
I think to address it, we have to look at our society. Everything is instant gratification on an application, or you have instant knowledge. So people think that they can do all of this without the help of experts. And what we're finding is, they get on, they look for everything, and then they hit a wall, because there is a lot of expertise required for a real estate transaction. And I think what we try and tell people to do is, we're not going to tell you not to look. We're not going to tell you that. But I think that millennials and everyone else realizes that when you have the largest financial transaction you're going to make in your life, that it requires a team. And I think the way your organization approaches it and the way our organization approaches it, we don't want a realtor, we don't want a lender and a borrower. What we want is a team that identifies all of your concerns up front and then can help you shop for the right situation. That may be a house over here, maybe a house closer to a school, maybe all of those things, but you can only identify that with a team. And that team is there for you, a realtor, a lender, and a professional. Getting pre-qualified really is the first step in identifying what you should be looking for. So why go to Trulia or Zillow, or for that matter, just call up an agent over here to see that house and call an agent over there to see that house? Why do that when you can get a team prepping you for the right decision? Then you can shop. It limits bad choices and expands what you may or may not have qualified for.
You get better service overall, though, too, right, Dean?
Terrific, better service and better direction that's going to save you time and quality. Because, when you find out what a person really wants, a realtor can nail that down. I want to be in this school district if I have 3 kids. Or I don't want to be in that school district because I don't have any kids. I'd rather be over here closer to work. Mm-hmm. Those decisions and the expertise that realtors bring to the table can help you do that. And then a lender can tell you, okay, here's what you qualify for. Remember, what you qualify for may not be your best decision, and that's where an expert comes in. You can make enough money to qualify for something. That doesn't mean that you should make that purchase. And once you talk to an expert advisor, they're going to say, well, what do you do? Well, I want to buy a boat. I want to do... Don't get yourself in a house payment that's going to limit all your other choices then. So that's why that team can really help you make the right decision up front. Cut down all of the choices, make the process easier, streamlined, and actually better to your taste.
There's nothing like having that cavalry or that force behind you, people who breathe this and do this every single day. And that's why this relationship with Rocky Mountain works so well with us, because it's easy. They know our ins and know our outs, and we're able to establish a better protection front for our buyers so that they minimize their mistakes,
Avoid the potholes.
Yeah, absolutely. Okay, let's talk about what are some everyday loan options a first-time buyer, or just in general, a buyer should expect. What are the common loan options? And then we'll kind of get creative on if you have this option, if you have this thing going on in your life. What are some basic loan options that we should inform our buyers on today?
Well, it's pretty much standard. It's conventional government. So whether you're going conventional with the down, whether it's 3% as a first-time home buyer, 5%, or if you're going 3.5%, or again, the down payment assistance. So again, what we want to do is we want to kind of do that interview and find out what you're really looking for, what you have, credit scores. There's a lot that you have to put into place to figure out what's the best program. And then based on what we have in front of us, and that's the kind of program that we're able to put them in, and then provide the best option for the buyer. And then it's up to them whether they want to proceed with that or go a different route.
So if I say something random like a buyer that I send your way says, I don't want PMI, what do you do that?
Well, at that point, then of course you look at the programs. For example, you would go maybe conventional, or you would go with the higher down, so that if you are going, FHA, for example, that has PMI, unless you're putting more than a 10% down, then you eliminate that. Or you go conventional and say you're going 20% down, and then you're looking at better rates, better positioning for yourself as well.
And what if someone says, I just want better interest rate?
Well, you always, it's also credit driven, but you can also buy it down. So again, there's options for every buyer. It's just a matter of what you're wanting to do and how we can make it work for you.
Got it.
I think that it's important to realize that realtors should sell houses and not down payment. And I think a lot of times that we see newer realtors just want to make the sale. And I think that in a situation where there's differentiation in lenders and realtors, and I think it's important to identify that. People that take time to add value to your process, your team, what we're doing here today, that adds value to the transaction that everybody gets paid the same amount on. So you're going above and beyond. When you're shopping for a lender and a realtor, I think that's important, because you may think that you don't want to have a down payment, but the discussion that we just had earlier about what down payment does and how it impacts you is huge. And a realtor that understands that says, you may not want to have a down payment, but if you put 5% down, this gives you this interest rate, and it also gets you out of MI in 6 years instead of 18 years.
MI is what?
Mortgage insurance,
Okay.
which you had brought up. And mortgage insurance is a protection for the lender, which I would debate it's not, but it's also the reason that you can get loans over 80%. And it's valuable, but a lot of times it's money that you can save for your future instead of paying for an insurance that may never get used.
Absolutely.
So I think that 10% down, 20% down, even FHA, Brenda misspoke, FHA has MI for life of loan now. Mm-hmm. Now it drops, but it's still life of loan. So you do an FHA loan, you're paying mortgage insurance for the entire life of the loan. Our recommendation is you can get an FHA loan, put more down, you can accelerate your principal reduction, and when you qualify, get a conventional loan and get rid of MI. So there's all kinds of tips up front that can change the game. And I think that tools about mortgage calculation and using those things in front of a borrower gives them a better sense and confidence that, maybe my parents can give me 5% down. Instead of that quinceañera or that new car, maybe they can give me 10% down, because 10% down today may save me $35,000 to $40,000.
It's amazing. I would love someone to give me a analysis as to what the average quinceañera costs. I'm assuming it's 5K. I'm assuming it's 10K.
More than that, and even a wedding. Think about this. If you're really thinking about doing something for your children, instead of $35,000 to $40,000 for a wedding, which is the average cost, it blows my mind. What if you put $40,000 on a $200,000 house? What does it do for your payment? What does it do for your MI? What does it do for your children's future and your grandchildren who are going to be able to live in a house that could get paid off in 10 to 15 years?
And then you could still enjoy the fruits of your labor at that point.
Right, and you have more money to spend monthly, so you have a better budget for your family. You can do more. You can save for their college instead of paying a house payment.
there's nothing worse. I have a lot of friends that I bought my first home when I was 19, and I was struggling. I'm not gonna exaggerate. I was a roofer. I was a painter. I was selling shoes at Dillard's, selling vacuum cleaners. I was doing every meaningless job just to try to get ahead on my mortgage, and I almost foreclosed on that first mortgage because I was young. I was dumb, but thankfully I did buy in a good area where the appreciation went up in value. But my concern was that did I buy too much house? Did I buy too much house? So I had a house, which is great, but my life kind of sucked. There was times when I couldn't put food in the fridge. Like you want to get to a position where you're not house poor, right?
Correct.
And what's house poor? Let's talk about that. You have a nice house, but you're still
you're struggling to make your monthly payments.
Yeah.
You don't have everything you want, the luxuries that you think you could live. There's vacations limited. There's credit card spending, or you start charging on your credit cards.
There you go.
Let's talk about something even simpler than that. What the government says is that a 50% gross total debt ratio is acceptable. Well, the first myth that we need to talk about is who gets to spend gross income?
Nobody.
Do you?
Nobody.
No, I don't. Nobody does.
No.
So why are they calculating on that? Because that's not a true measure of your income. The second thing is if you're at your budget, okay, you still have food, you still have all the utilities, you still have all those things. But what if your engine blows up on your car? Mm-hmm. How do you pay that $700? Mm-hmm. One thing about Rocky Mountain Mortgage is we service 20,000 customers. Okay, so you're servicing all the loans that you've done, and you hear their stories. And I think it's important that people hear those stories. I can't make my mortgage payment because my engine blew up and I need to go to work. Well, think about that statement.
Yeah.
That tells you when you go to that maximum buying too much home, what it costs you. And I think that a lot of times people realize, well, we need bedrooms, a kitchen, we need a garage, and we need to be in the right area. Do I need to have the biggest house or the smallest house? You just got to find what your things are. And I think one of the things that our loan experts we're teaching them to do is talk to the borrower, learn about them. And we talk about things like form, family, occupation, recreation, and money. And I think if you just spend a few minutes identifying those priorities for your borrower, that you as a team together can identify what the maximum that borrower should take.
I had a recent, just as I'm picking you guys as Brenda, I had a recent client that maybe like 7 months ago that said, Rick, I could get approved for $700,000. And I'm like, okay, so you want me to send you homes up to that point? He's like, no, $300,000.
Yeah.
And I was like, let me worship the ground you walk on, big guy.
Smart guy.
He's like, it's four of us, $300,000 in El Paso will get us 5 bedrooms.
Yeah. I don't need to go further.
I don't need anything else. And so it was really refreshing for him to see the light at the end of the tunnel, right? So that's really cool.
Let's talk about one other thing that you just brought up. The cost of the home in El Paso, Texas, even when you pay it off, Rick, what are you still left with every year?
Property taxes.
Property taxes.
The
They
highest.
keep going
They're
higher.
high.
And people do not understand that if you buy a $200,000 house, which is just slightly over what the average closing was last month, that's $6,000 a
We're
year.
at 3%.
In taxes. That is $500 a month just in taxes. It's not part of your principal and interest payment.
So I have $500 a month in property taxes. Let's just say on a $200,000 home. And we have a lot of BMW kids out here that have an $800 payment.
Yep.
More than they can afford. So in just 2 items, their car and their property taxes are over $1,300 a month. And I'm not even talking about their car insurance or their home insurance. So
average family in El Paso for a family of 4, $45,000 a year in income. 50% of gross is $22,000. Okay, that breaks down to less than $2,000 a month. If you have a regular car payment now, it's just under $500. So now you're down to $1,400. If you have $400 a month in groceries, now you're down to $1,000.
That's no
and you're going to
Starbucks.
have a house payment on a $200,000 house that the mortgage payment itself is not that large, but you add the $550 because you got to pay insurance every year. And all of a sudden you're looking at it going, I qualify or do I really?
Yeah. All right. That's buy smart.
Buy smart.
Buy smart. Buy smart. Okay. What about the person who says, I don't have amazing credit? Am I a lost cause, or can I still become a buyer? Are we just going to turn and close Noah's Ark on them and say you can't enter into the promised land here? Or what can we do to A, get them into a home with some creative loan options, or B, what step should we do for them?
Well, it's never a rejection. It's never a true denial. It may be that at this moment they can't get a home, but it could be 6 months, a year, depending on what the situation is. If the buyer's willing to, work at it, we have credit repair. We have a national credit repair that I'm sure Dean's going to talk a little bit more about. But it's a matter of working on their credit. It will get them a better rate if they just save versus going even maybe a hard money lender. At that point they can be saving money. There's options, but again, it's really about working, because it's not just about getting a credit score. You have to have the history, the capacity. There's a lot more to than just a credit score. You may have an excellent credit score and have no credit history. So reality is, you need other things to strengthen that. But it's not a lost cause. It's something that the mortgage advisor, the expert that you come, will actually work with you. And it's something that, as I mentioned, it may take a couple of months or maybe even a year or two.
Is there any, granted, I don't think you guys could give me a concrete number, but is there a barometer range for a person who is just not at the credit score mark that you guys would want? What's close enough?
Well,
what's close enough?
There's a couple of ways to look at it. I mean, FHA allows for you to get 90% financing with a 500 FICO score. I truly believe that we get hung up on credit scores, because to me, if you have a 500 FICO score and it may be medical collections, but you have 12 months rental history in an apartment complex that shows that you have the discipline to pay a mortgage history, that means a little more to me. So maybe we look at finding you 10% down. The problem comes, FICO scores are tied to interest rate. Okay? So most people want to be above a 640. Okay, you can get an FHA loan, and we do FHA loans down to 580. We do with a 3.5% down. But the reality is, for you to make a sound financial decision, do you just want to get into a house, or do you want to get into a house at a rate that you can live with, that's going to give you a payment that you can live with? Because home affordability is based on price and interest rate. And we all know interest rates are going to start climbing again. And when they do, it's going to impact your ability to buy a home. So our advice is always do's and don'ts. Start paying your bills. Pay them right away. Pay them on time.
Love that.
The second thing is identify your credit score and go to somebody. There's two types of credit repair agencies out there. And I want to talk to you, the group and your audience, about this. Credit repair people that say, okay, give me $1,500 and I'm going to repair your credit. Be very cautious.
Absolutely.
Okay.
Kind of like a debt consolidation.
It is. It is. We deal with a company, nationally recognized company, but their methodology makes a lot more sense to me, who's been in the industry for 34 years actually. And what they do is they give you an initial consultation. They look at your score. Sometimes credit repair is not what we're talking about. If you want to go from an FHA loan to a conventional loan and save MI, you want to take your score from a 640 and you have decent pay history to maybe a 700, which is going to get you a conventional loan and lower MI payments. They can work with you to get 20-point increments over a period of 3 to 4 months. Let me ask you, what's the difference between getting a 5% rate on a $200,000 loan or a 4.25% rate on a $200,000 loan with a lower MI premium? Because it's all based on your FICO score. And that's not just a difference up front. That's a difference over time. Again, wealth, okay? Building wealth. All of these little decisions that you make shouldn't be impulsive. They should be with a team, a realtor and a lender that's going to help you say, okay, you're at a 660, which is pretty good. But if you wait a couple of months, we'll get you to a 680 or a 700. It's going to save you a ton of money.
And it's not that hard to actually do that.
It is not.
It's lowering a couple credit card balances below a percent threshold. You're talking about maybe you're at a 75% maximum usage. We'll lower to 50% or 30% inquiries.
30, yes.
Right? So those are the things that little tips to try to get them over the hump. Okay, Dean, let's talk about this. Let's a snapshot of where we're heading as our economy. Give me the rundown, a basic rundown as to what's going on in our economy, not only in El Paso, but just what you see going out there through your books and through your lenses here.
It's a really good circumstance right now that we have. El Paso has got the lowest unemployment they've had in decades. And what does that mean? That means that wages are going up, which is something that we haven't had here in El Paso. So as wages go up, people are more likely to buy homes. Family formation is better. They're more comfortable in their circumstance, and they can do things like buy homes with down payment. And it drives all of our economy because as we have more real estate transactions, that employs more people. It's kind of a self-fulfilling prophecy to maintain a good economy. Logistics, we do about $89 billion between Mexico and El Paso annually. It's a very good situation right now. Nationally, our economy is doing terrific. We had a really good growth month, annualized at 3.2% growth GDP, which is very high. It's probably not going to finish that way, but it's good. Manufacturing's up. That's good. Inflation still held at bay, which is one of the reasons why interest rates are still low. And secondly, the global economy is not doing great, so it's driving our stock market. So your retirement funds are going up and gaining steam, and we still have low interest rates because they're concerned about the global economic picture. The bottom line is we're in a good situation. Labor-wise, we're in a good situation with a couple of things. On the downside, homes have become less affordable because for 20 plus years, builders have not been able to keep up with demand. So when that happens, lower demand equals higher prices on new construction. So is there a differentiation in our market between resale and new construction? But there's plenty of houses out there.
Quick question, because I want to jump on that, because it's a good point. Is there an oversaturation in new construction at this point, you think?
There absolutely is not. As a matter of fact, we're suffering right now from inventory problems because some of the lots did not come out in time. So builders are scrambling for inventory. There is one other thing that I want to cover with you, and that's the time it takes to build a home has increased. Because the economy's gotten better and because the oil industry is doing better, El Paso is suffering from labor shortage. As a matter of fact, Texas is. For labor shortage on home building. So it is causing a problem. It used to take 3.5, 4 months to complete a home. Now it's closer to 7, 8 months to complete a home. So we want our borrowers to be patient because there isn't the labor force. A lot of people drive to Midland during the week because they can make $100,000 driving a truck. May not last forever, but it's pretty good money, so people are willing to do that.
And the principal residence is in El Paso, but they still live over there.
Absolutely.
I mean, they still work over there.
Yeah, and so that is a problem that we're suffering locally. Not enough labor, skilled labor for those areas. One thing I would tell us in general as a wealth tool, people get hung up on having to have a bachelor's degree, and I think that should be put to bed. A bachelor's degree is great, but our country is truly suffering from skilled laborers, and skilled laborers can make a heck of a lot more than you think.
Absolutely.
You get a bachelor's degree and you get out of school, you're looking at $30,000, $35,000 starting if you're lucky. You become a plumber, a framer, or an electrician, within 5 or 6 years, you're making six figures. The average electrician in the state of Texas is over 55 years old, making six figures. Average electrician, same thing, making over six figures. I recommend if you don't feel college is for you, don't go. Pick a trade. Because I can tell you this.
And it's less expensive than your student loan.
You don't have student loans, which will keep you from
That's
buying
another
a home.
podcast, but
will
yes.
keep you from buying a home if you have a ton of student loans. We didn't even talk about that, but that's huge now.
Yeah.
So I think it's from an economist to tell you that you don't need a bachelor's degree. You need a trade. Your parents are right, but think about what you really want to do and how fast you want to do it, because there's other options in our economy today that we didn't look at 15 years ago. We used to look down at those trades. Don't look down on them. They're going to be looking up when they buy a bigger house than you because they have a bigger paycheck.
I had a meeting yesterday with one of I'm launching an investment property. I'm getting my whole entire staff to help, and I'm gonna Airbnb the product. But anyway, my electrician came in, and we were talking. His daughter wants to become one of my realtors. Anyway, we started talking, and he didn't go to school. He has his own electric company. He's doing very well. He does a lot of residential, but a lot of commercial work around the city of El Paso and in the state. He's traveled to Kuwait and whatnot. And I was telling him, like, do you realize that you make maybe 2 to 3 times, maybe even 4 times more than a person with not a bachelor's degree, but with a master's degree, and you don't have any student loans? And he's all, I love it every day. He's all, every day that someone tells me that, I absolutely love it. And he's not an economist. He doesn't know the analysis and the numbers behind it. But as a former educator and high school principal, I hate even saying this, but there's a degree saturation in today's market. Your value of your degree is worth peanuts in today's market, especially if you don't have the skill set in the workforce, right? So if you're not able to compete, hustle, have some grit or some grind to your resume, it doesn't really matter if you have a degree in psychology from some random college. It's not gonna impact your life. And then you're trying to qualify for a home, but you have $30,000 to $40,000 or $60,000 in student loan debt, and then you're screwed. You're screwed at that point. So, guys, last question. Very quick question. This impacts me, and I know it impacts a lot of your realtors that you guys service. Because I get this all the time. If I'm a self-employed, I'm a business owner, or a 1099 employee, I do not want to pay Uncle Sam everything that I make. So that's why you have all these itemized deductions. You do it legally. You try to make sure that you lower your tax threshold. So, like, let's say an example. Let's say someone makes $150,000 through his expenses and deductions that he creatively analyzes with a CPA. He shows that his GCI is probably $30,000. Legal, it's fair, but what options do we have, though, because we're not the standard W-2 employee? If it's what I call a qualification year.
That 2010 Dodd-Frank put the clamps on that big time. Self-employment is analyzed to the teeth right now. So your GCI is what's going to be used. Unless you have paper depreciation, that's the only thing you can add back into your income. One thing that is coming, though, as we've been exposed to over the last year, is what we call non-QM products. These are not necessarily your previous subprime products, but what they do is they give you the way to analyze bank statements versus the tax returns, analyze your income from your 1099s versus the whole income tax. And so those products are out there. They are a slightly higher interest rate, but they're not the 20% down product that we used to have. They're probably more 10% down. So if you're self-employed, you either want to do 2 things. You want to modify your taxes to make sure that you have enough to qualify for a home that you want to purchase, which, again, a lender can tell you this is what you're going to need if you want to qualify that. It may be a 2-year process.
So for me, though, here's, I'm speaking on behalf of realtors or people who are 1099s. I'm not a 1099 because I'm self-employed. I give 1099s. But anyway, if I show, for example, if a person shows that they make $100,000, they're going to pay an arm and a leg. They're going to pay an arm and a leg to Uncle Sam. I've heard, and for me, myself, I would rather pay that towards a down payment than pay Uncle Sam. So as a result, that's why you get creative and you maybe lower your GCI. It impacts us on the qualification end, but then we have larger capital for you guys to analyze on our deposits, right? And
that works exactly what I was talking about. Yeah. You're either looking at a down payment situation or a qualification situation. And I think one of the things of the new tax law, though, is it's more beneficial to somebody that's on 1099s because they don't have to be as creative with their deductions. If they have kids, they get to write off $24,000 right off the bat, lowers their taxable income. So maybe they don't have to be as creative, and it still doesn't change their gross. And that's where you're going to have some benefit. And let's face it, most realtors in our game or self-employed, I wish that they all made $100,000 a year, but in general, they don't. The top 10 to 15% do. The rest are in an area where if they're making $50,000 to $60,000 under the new tax law, they don't have to be as creative. They don't actually have to track as much. They can write off the $24,000 and move on down the road. Okay,
so deposits will play a big role for someone, right? They have excellent credit, but let's just say they want to show 30,000 GCI, but they're making $250,000. So that's where you're going to see their normal daily habits in their deposits, right? Like if they're getting huge chunks of deposits, and they should be fine, you think?
Well, like I said, they're still going to end up in one of those non-QM situations, but they're becoming more and more frequent and more competitive. And so I think that they're going to move in that direction. Now, I will tell you this. There is a bill in the House right now to address the difficulty of a self-employed borrower to get a home.
Okay.
So that may change as well.
Love it. Any closing remarks?
Get with the lender, get with the realtor.
Love it, love it, love it, love it. Guys, I couldn't be more happy to have my two guests here. They are my preferred lender here in El Paso. They will give you all the ins and outs when it comes to acquiring the correct loan that is catered towards your specific finances, which is most important. Instead of just kind of boxing you into a specific loan program, they will kind of be a concierge service to what you're trying to do, which is really important. So I'm going to shoot out their numbers real quick, guys. We got Dean Inniss. He's the president of Rocky Mountain Mortgage here in El Paso, Texas. His number is 915-593-3111. You will see it at the bottom of the screen. Your email, Dean?
DINNISS@RMMC.com.
And then we have Brenda Aguirre. She's a vice president of Rocky Mountain Mortgage. Her phone number is 915-539-0084. And your email is?
b.aguirre@rmmc.com.
Love it, guys. We will see you at the top and at the next episode. If you like this podcast, please tell the internet gods by pressing like, and also tell your friends and family members. Hit the subscribe button, and we'll see you on the next show, guys.